Numbers don't panic, people do. Let's look at the psychology driving today's market. Capital does not chase recent winners only because people love momentum stories. It can chase them because recent success starts feeling diagnostic. That feeling is powerful because past performance is visible while future conditions remain uncertain. Visibility gives the winner a social advantage over quieter alternatives. The opening tension is social as much as analytical. When a strategy has been working, the crowd can start treating that recent pattern like evidence of a stable law. A strong run can start impersonating a law of motion. The temptation is understandable. A live winning streak feels more concrete than an abstract warning about changing conditions. The live streak feels firmer than abstract caution. The opening tension is social as much as analytical. But the deeper puzzle is why capital can help extend the very trend it thinks it is merely observing. That is why recent returns gather so much attention. To answer that, we need to look at representativeness and flow together rather than separately. The pattern becomes persuasive before it becomes understood. The opening tension is social as much as analytical. At the surface level, recent winners attract attention, conversation, and comparative evaluation. Attention is the first fuel in the loop. That is what the viewer can recognize in practice. Once attention concentrates there, allocators begin asking whether they are underexposed to what appears to be working. Visible winners create a benchmark for everyone else. That is what the viewer can recognize in practice. That question is social as well as analytical because nobody likes explaining why they ignored a visible winner. Underexposure starts feeling like an explanation problem. That is what the viewer can recognize in practice. So the crowd does not respond only to returns. It responds to the reputational pressure created by returns. Reputation joins the allocation decision quickly. That is what the viewer can recognize in practice. The more recent strength becomes the reference point, the more neutrality can start feeling like a missed opportunity. Neutrality can start looking like a missed chance. That is what the viewer can recognize in practice. That is where a descriptive pattern begins to turn into a behavioral force. Description becomes pressure once the winner is public. That is what the viewer can recognize in practice. Representativeness sits at the center of the mechanism. Representativeness is doing heavy work here. That distinction keeps the mechanism visible. The distinction keeps the mechanism visible. A recent run of strong results can feel like a compact story about underlying quality rather than one period inside a larger distribution. A short run starts standing in for a bigger explanation. The crowd then starts treating recent performance as representative of a durable state. The crowd treats the pattern as more stable than it may be. That distinction keeps the mechanism visible. If enough capital does that at the same time, flow itself can reinforce the impression that the story was correct. Flow can then reinforce the impression of quality. Prices, narrative attention, and institutional comfort can all move together for a while. Participation begins to support the interpretation. That distinction keeps the mechanism visible. A small shift can compound quickly. What began as interpretation then becomes participation. Observation becomes involvement. That distinction keeps the mechanism visible. The comparison pressure stays quiet. The comparison pressure stays quiet. The comparison pressure stays quiet. And participation can temporarily produce the continuation that interpreters thought they were merely detecting. That is how continuation can look self-confirming. That distinction keeps the mechanism visible. The public range starts shrinking first. That is why the line between observation and reinforcement gets blurry in crowded winning trades. The line between seeing and extending gets blurry. That distinction keeps the mechanism visible. The first step is a visible run of favorable recent outcomes. A visible streak comes first. Each step adds to the same feedback loop. The first step looks harmless alone. The second step is extrapolation. Recent success starts standing in for a richer analysis of why it occurred. Then extrapolation stretches that streak into expectation. Each step adds to the same feedback loop. The third step is benchmarking pressure. Allocators compare themselves against the recent winner and feel behind. Benchmarking pressure spreads through comparison. Each step adds to the same feedback loop. The fourth step is reallocation. Capital shifts toward the visible success because visibility itself has persuasive force. Capital moves because visibility is costly to ignore. Each step adds to the same feedback loop. The fifth step is reflexive support. New flow can help sustain the pattern for a period. New flow can help the story keep working for a time. Each step adds to the same feedback loop. The sixth step is narrative hardening. Continuation is then read as further proof that the original extrapolation was insightful. Continuation then looks like proof of insight. Each step adds to the same feedback loop. The seventh step is crowding. More participants arrive because the pattern now appears both profitable and socially validated. More participants arrive once the story sounds validated. Each step adds to the same feedback loop. The eighth step is vulnerability. The same concentration that supported the move can later make the position fragile. Crowding quietly accumulates in the background. Each step adds to the same feedback loop. The ninth step is confusion. People struggle to separate signal, flow, and story because each has been reinforcing the others. Fragility can grow inside apparent confirmation. Each step adds to the same feedback loop. The 10th step is hindsight over confidence. The crowd remembers the trend as obvious even though the process was contingent. Hindsight later makes the path look obvious. Each step adds to the same feedback loop. This is why performance chasing is not just greed in a cartoon sense. This is more than a cartoon story about greed. Each step adds to the same feedback loop. It can look rational inside a visible scorecard because the evidence is easier to narrate than to contextualize. Each step still adds pressure to the same feedback loop. The problem appears when recent evidence is asked to carry more predictive weight than it can support alone. Recent evidence gets asked to carry too much weight. Each step adds to the same feedback loop. Then the crowd is no longer just observing the winner. It is helping to enlarge the winning pattern. The crowd helps enlarge what it admires. Each step adds to the same feedback loop. The mechanism can produce temporary self-fulfillment without proving long-run durability. Temporary reinforcement is still not long-run proof. The missing width becomes the real issue across the market crowd. A fair counterpoint is that recent performance can sometimes contain real information. Sometimes recent strength does contain real information. That keeps the explanation properly bounded. The explanation needs a boundary here. There are periods where improving fundamentals, better execution, or genuine structural change justify continuing interest. Structural change can justify real persistence. That keeps the explanation properly bounded. A counterpoint still deserves space. So not every flow toward a recent winner is pure representativeness bias. Not every flow toward a winner is biased. That keeps the explanation properly bounded. The pattern does not explain every case. And conceptual analysis should not pretend it can mark the exact point where signal ends and crowding begins. Timing the boundary remains hard. That keeps the explanation properly bounded. The narrower claim is enough. Collective extrapolation can become part of the force keeping the pattern alive for a time. The narrower claim is enough for this lens. The mechanism weakens when allocators distinguish visible outcomes from the reasons those outcomes were generated. Collective extrapolation can become part of the force itself. That keeps the explanation properly bounded. That brings us back to the opening puzzle. Why does capital follow recent winners so persistently? The mechanism weakens when causes outrank scorekeeping. That keeps the explanation properly bounded. Because recent success becomes a socially validated shorthand for future promise, especially when uncertainty makes deeper analysis harder to communicate. The opening puzzle is about social shorthand in uncertainty. Once that shorthand spreads, allocators can move not only because they are convinced, but because standing aside becomes harder to defend. Standing aside becomes harder to defend in public. The crowd creates the feedback. The crowd helps power the continuation. This answers the opening question directly. The mechanism matters more than the headline. The mechanism matters more than the headline. The feedback then blurs whether the continuation was discovered or partially manufactured by the response to discovery. That does not prove the trend is durable forever. This answers the opening question directly. That does not mean every winner is hollow. It means recent performance can acquire causal force through the crowd's reaction to it. It shows how reinforcement can masquerade as discovery. The blind spot lies in confusing reinforcement with proof. The blind spot is confusing extension with evidence. This answers the opening question directly. The path looked easier before the test. When that confusion grows, the market can reward the story that recent success tells about itself. That confusion makes winning narratives even louder. This answers the opening question directly. So the resolution is that performance chasing persists because recent winners can look representative while incoming capital helps make them temporarily more representative still. The loop is strongest when visibility and participation align. From there, the practical takeaway is observational rather than directional. The better question is what the winner now depends on. This answers the opening question directly. The takeaway should stay observational. Watch for how often recent outcomes are discussed without equal attention to the mechanism that produced them. Observe mechanism before admiring momentum. Use it as a study lens, not a market call. Notice whether allocators are responding to deep causal change or to the social discomfort of lagging a visible winner. Watch whether the story outruns its original cause. Ask what part of the trend may now depend on fresh participation rather than on the original catalyst alone. Social lag pressure matters almost as much as returns. Compare behavioral feedback with structural explanations before reducing the move to one story. A trend can be maintained by the chase around it. Keep the claims qualified and bounded. Price is evidence of transactions, not a direct reading of emotion. Behavioral interpretation should not be mistaken for a trading call. Use it as a study lens, not a market call. Behavioral interpretation can clarify the loop, but it does not tell us when continuation ends or reversal begins. The goal is to see reinforcement while it looks like discovery. The point is not to front-run the crowd. The point is to see when the crowd may be helping turn observation into extension. The lesson is observational and specific. When recent winners start looking self-evident, ask how much of that evidence now includes the capital that chased them before drawing strong conclusions. Keep the lesson observational and qualified. The lens is descriptive, not predictive. Don't follow the herd. Study it. See you next time.